Harmonic Trader Education, Harmonic Trading, Certified Webinar Series. Lesson: Trade Execution Introduction, Price Bars in the Potential Reversal Zone, Trend Channels, and Patterns with RSI. Three stages of harmonic trading, a review. If you recall from past webinars, we break down harmonic trading into three steps. Trade identification, regardless of what type of trading system is utilized. The initial step is identifying a potential opportunity. Harmonic trading techniques utilize historically proven and repetitive price patterns that capitalize on overbought and oversold signals generated by the market's technical price action. A good portion of this material is dedicated to identifying and differentiating harmonic price patterns as quantified by Fibonacci ratio alignments. Understanding the differences among the various harmonic patterns is essential to capitalize on specific trading opportunities. Trade execution. After accurately identifying a potential trade opportunity, the actual trade itself must be determined. Several considerations must be assessed within a specific time period that is defined by the potential opportunity. The validity of the pattern must be determined, and the final action of executing the trade or not must be considered. And the final step is trade management. After the execution action is decided, there are a variety of general considerations involved with the trading process. If the trade was executed, the position must be managed within specific rules to maximize the profit while minimizing the risk. The harmonic trading plan. Again, a quick review of our harmonic trading checklist. This is important to assess before we even consider executing a trade. Is there a pattern? What is it? Is there an ABCD component? Where does it complete? Are there three or more numbers converging in the potential reversal zone? What are they? What are the time cycles suggesting? The symmetry of the pattern and the comparative intervals suggesting? Are there any warning signs? At what point is the potential reversal zone no longer valid? That is, what's the stop loss for the trade defined in advance? Are there secondary confirmation factors such as trend channels, relative strength, or other harmonic considerations that complement the potential reversal zone? And we'll get into that in this webinar. And finally, how much must I risk? That is, again, the stop loss, and am I willing to risk it? Trade execution. Price action in the potential reversal zone. It's important to assess the validity of the opportunity through proper pattern identification and the examination of the price action in the precise potential reversal zone. It's important to look for confirmation factors such as RSI, trend channels, and additional harmonic factors. We must determine the ultimate execution, that is, pulling the trigger, and then manage the position according to the harmonic trading rules. Trade execution reversal possibilities. Effective execution requires the discipline to examine a precise potential reversal zone and understand in advance all reversal possibilities. Trade opportunity results in basically one of three possible outcomes. First, it possibly can trade past the potential reversal zone into the stop loss zone, thus either incurring a loss or negating the trade altogether. Second possibility is that a trade and price action could reverse slightly off the potential reversal zone and then consolidate for some time. The third possibility is that price action could reverse off the potential reversal zone and provide a nice cushion within a relatively short period of time. These are the easiest situations, and we'll get more into that when we look at trade management. But for right now, for trade execution possibilities, these are essentially the three possible outcomes that we must assess. Potential reversal zone, the PRZ. It's the harmonic window of opportunity. Potential reversal zone is the specific range, that is, the critical make or break level that determines the validity of a potential pattern. Again, we must employ confirmation signals simultaneously within price parameters of the trade. The validity of the pattern must be assessed relative to the current trading behavior. Each price bar that follows the initial test of the PRZ can provide more information regarding the future potential of the existing opportunity. We must balance the commonality to give back some of the reversal in order to allow breathing room, if you will, for the price action to assert itself, and then to determine the extent of the possible move. It's important to focus the entire harmonic trading decision-making process within the PRZ, especially immediately after the completion of harmonic patterns. And it's essential to be there the first time. That is, be prepared in advance before the pattern completes so that we can make the proper anticipations and facilitate our execution process. Price bars at the pattern completion point, that is, in the potential reversal zone. It's important to analyze the price bar formations within that exact PRZ range, again, to provide early signals of validation. Potential reversal zone trading anticipates specific price action within the price range after a pattern has completed. Now, trading execution is determined immediately following a pattern completion, after the terminal price bar is established. But what is a terminal price bar? The terminal price bar is the price bar that tests the entire potential reversal zone and marks the price level where the pattern can be considered completed. In this illustration, we look at the price action after it hits the entire zone of a pattern. Price action should reverse after the entire range is tested. We must assess the potential reversal zone, particularly at the XA retracement or projection. That is typically the largest leg of the pattern. It's important to take note of the relative ABCD structure in comparison to the XA calculation. Again, we want to assess confirmation factors, RSI, volume, trend channel considerations simultaneously with the reversal progress in the PRZ. The terminal price bar should close above the PRZ shortly after completing the pattern in a bullish setup. In this example of the Australian dollar on a 5-minute, we see a bullish butterfly. Now, despite the extreme price action upon hitting the entire zone, it's important to notice that this single price bar marked the exact low for the move. Immediately following the entire test of this zone, despite the fact that it exceeded the ideal potential reversal zone, the price action started to stabilize. These are your early signs of a valid reversal at hand. Now, again, despite the fact that the price action exceeded this pattern, it was still valid because immediately following the completion of the pattern, the price action stabilized. And this is an important concept because a lot of times people might assume that we execute a trade immediately at the potential reversal zone, and this is simply not the case. What we want to do is we want to be there in advance, wait for all of the numbers to be tested in the potential reversal zone, and then take action on the next price bar, no matter what happens, and look to execute within that potential reversal zone or slightly below it in this bullish setup. Now, a bearish terminal price bar must exhibit the same behavior. Price action should reverse after the entire range is tested, and it's important to assess the potential reversal zone, particularly at the XA retracement or projection, again, typically the largest leg of the pattern. Take note of the relative ABCD structure in comparison to that XA calculation. Again, assess our confirmation factors, relative strength, volume, trend channels, all simultaneously within the reversal progress in the potential reversal zone. Now, in the bearish case, the terminal price bar should close under the PRZ shortly after completing the pattern. Here we have a really distinct bearish bat in JP Morgan on the 60-minute. Now this was a real nice setup with a real nice reversal. Looking at the price action in the potential reversal zone, we see that the entire reversal occurred immediately after testing all of the numbers in the zone. We're not looking to execute the trade at the terminal price bar, but at the next price bar. Therefore, we wait for the entire zone to be tested, and then we look to execute our trade in the potential reversal zone while allowing the terminal price bar to establish that extreme high for the setup. Again, we take note of the price action immediately following the complete test of the zone. Clearly, in this case, after a decent intraday rally, the price action stalled exactly at the numbers. This is the type of price action we want to see in the best setups and the most valid harmonic patterns. Now there's various types of price bars that can be used in charting purposes. A normal or standard price bar is typically a line bar, but an open, high, low, close. Japanese candlesticks, which have been around for hundreds of years, is actually preferred most for harmonic trading purposes. Another form of price bars is point and figure. However, this only plots trading results when new lows or highs are made. These are interesting for ratio measurements that can pinpoint retracements and expansions, but this method is not as good for patterns. Now, the standard line price bars is pretty simple. The initial open is on the left side of the bar, followed by the low to high range, and then with the close on the right side. The bearish standard price bar shows the open on the left side, typically the open above the close, with the high and low range exhibited by a single line with the close below the open. Now, again, for harmonic trading purposes, the Japanese candlesticks are preferred. In using and looking at Japanese candlesticks, they are denoted in two forms. Now, the bullish candlestick is usually a clear or a white-bodied bar. The open, if it's a clear or white bar, the open is going to be below the close with the high and low exhibited by a lined range. Now, the close itself, again, will be above the open. And then if the close is above the open, the total price bar will be either clear or white. The bearish candlestick is usually going to be either black or some type of colored price bar where the open is above the close. Now the close will mark and indicate whether or not the body of the candlestick will be colored. There's several different types of candlesticks, and we'll briefly review these, but there's a lot of material on Japanese candlesticks that I recommend. A good friend of mine, Greg Morris, wrote a fantastic book on Japanese candlesticks, and also another well-known technician, Steve Nissen, has written basically the encyclopedia of candlesticks, if you will, and I recommend that you research both of these technicians' work. But for our purposes, we're briefly going to review what these candlesticks mean. The doji is an excellent singular potential reversal signal, especially at the completion of harmonic patterns. Now, this occurs when the open and the close are the same for the exact time interval considered. Usually, the open and the close are found in the middle of the range. This price bar indicates a market that is uncertain of its future action. The essential key here is to watch the price action following the formation of the doji for early indication of future direction. A hammer is a unique type of candlestick that has a large total range with a small difference between the high and the low, approximately 1/3 the total range for a valid hammer. On this illustration, I show the normal version of a hammer, but inverse hammers exist. That is, the body of the candlestick is actually at the low of the price bar, not the high. Also, there are a variety of types of hammers. There's hangman, shooting star. Again, I leave this for your further review, but to just note that the hammer actually marks a unique range and unique trading interval where there is an indecisive or changing character in the trend. Hammer candlesticks work best when confirmed by price action, again, immediately following their completion. Harmonic pattern reversal types. In harmonic trading, there's actually two types of harmonic pattern reversals. The type 1 is a terminal price bar established as the reversal extreme, and price action continues in the counter trend direction without retesting the potential reversal zone. These are usually the most ideal and easiest executions and easiest trades to trigger. But a type 2 reversal is actually a terminal price bar established as the reversal extreme, and price action continues in the counter trend direction, but only briefly to retest the potential reversal zone for a secondary confirmation. Let's look at some illustrations and some examples. Here we have the type 1 bullish reversal, an ideal reversal, if you will. We see the terminal price bar that tests the entire zone, the entire potential reversal zone, and then immediately reverses in the new trend direction. On this chart of the gold ETF, the GLD, this is a daily, shows a real nice bullish Gartley, and this was a type 1 bullish reversal. Now, if we look at the price action in the potential reversal zone, we see that the one singular bar on the day that tested the entire potential reversal zone reversed immediately. Again, we're looking to wait for the entire pattern to be completed before executing the trade. But it's important to note how the price action stabilized and trend reversed immediately after the pattern was completed. In these kind of cases, that type of price action is going to give you the early indication of a valid reversal at hand. When we get to the trade management webinar, I'm going to show you guys how we break these down into different time frames so that you can capitalize on this type of price action. Sometimes these reversals can happen quickly, but if you're there before the pattern completes, executing the trade at the proper time interval, these are the easiest trades to handle. A type 1 bearish reversal, again, similar, where we see that the entire price action tests the potential reversal zone. But in this case, the price bar reverses immediately after testing all of the numbers at the pattern completion point. Now, ideally, we want to see the price bar hit the zone and then close below the entire range of numbers. Although this might take 1 or 2 or 3 extra price bars to fully complete before realizing an entire pattern reversal, it's important to note just that this type of character in a bearish reversal. Here on the chart of Microsoft on the daily, we're looking at a bearish butterfly that possesses a type 1 reversal. That is, the price action hit the entire zone and then reversed. Looking at this potential reversal zone chart, Microsoft tested all of the numbers in the zone. The price action immediately following the terminal price bar reversed quickly, tested all the numbers in the zone, and then began to roll over. Now, this type of price action in the potential reversal zone should happen fairly quickly, where immediately following the pattern completion, we see that the trend begins to head down. Now, a type 2 bullish reversal typically involves first a short and brief type 1 reversal where all the numbers in the potential reversal zone are tested, some type of nominal reaction, a bounce from the bullish support, followed by a secondary test. Here we see a chart of Standard & Poor's 500 March 2011 mini contract. This is a real nice bullish butterfly that possessed a type 2 bullish reversal. Now it's important to notice how the price action tested the entire range of support. The pattern completed, experienced an initial and sharp reaction, however rolled over for a secondary test before the major reversal ensued. Looking at the price action in the potential reversal zone here, we see that the entire number of all the numbers in the pattern completion point were tested. The price action stabilized immediately at that harmonic support, bounced quickly, but then rolled over to retest all the numbers in the zone. When we get into the trade management section of webinars, I'll show you guys how we handle these situations. But for now, from a broader standpoint, it's important to know that type 1 and type 2 reversals are handled differently. In this case, if we're looking at a type 2 reversal and a secondary test that is valid, after that secondary test retests the potential reversal zone, normally in valid cases, that's when you're going to see your big reversal and your big move. The type 1 move is typically going to be that quick reactive harmonic move, regardless of what eventually transpires, will give you a quick and sizable profit. Now, type 2 bearish reversal, again, test all the numbers in the potential reversal zone, establishes the terminal price bar, trades out of the potential reversal zone only to experience a secondary retest. Looking at this 15-minute chart of Pepsi, we look at a bearish butterfly that had 2 tests of the entire potential reversal zone. Looking at the price action in the potential reversal zone, we see that the terminal price bar was established at the number 1 point. Immediately after the terminal price bar was established, the price action rolled out of the zone temporarily, only to come back, retest the entire zone without taking out the prior high or taking out that terminal price bar, and then the larger reversal ensued. Harmonic patterns relative to the trend. Now, I have talked for some time about the nature of patterns, and harmonic patterns are primarily signposts of potential future and some type of corrective price action within the context of the larger trend. Patterns indicate execution areas within well-established trends. The potential reversal zone itself of the pattern within the trend can measure and define critical continuation areas. But there are 2 types of patterns within the trend that we want to assess. The first type is patterns in the direction of the predominant trend. Typically, these are continuation patterns. We're going to focus mostly on continuation patterns. Now, there are other patterns against the direction of the predominant trend. These are typically counter-trend correction patterns. Most of the time, these type of patterns are going to only yield a small and brief reversal while the predominant trend will quickly resume. We want to focus on patterns in the direction of the predominant trend, that is, continuation patterns, because we get the wind at our back, if you will, when we're looking at patterns that move in the direction of the predominant trend. ABCD patterns as continuation signals within established trend channels. ABCD patterns frequently serve as a minimum requirement before an established trend can continue in its predominant direction. Simple ABCD pattern in combination with the limits of a trend channel is typically sufficient enough to define a continuation opportunity. It's important to look at ABCD completion points and the trend channel constraint for the optimal price zone for the continuation of that predominant trend. In this illustration of bullish ABCD patterns within an established bullish trend, typically we see multiple ABCDs that will form to mark important continuation points. On this daily chart of the NASDAQ Composite, interestingly enough, the daily chart exhibited 3 consecutive ABCD patterns, each at the trend channel support that defined the critical continuation for this bullish move. In the same manner, bearish ABCD patterns within established bearish trend channels mark important continuation points within a downtrend. On this chart of Toll Brothers on the weekly, we see multiple bearish ABCDs within the established bearish trend channel. The important concept, though, to garner from this chart is that these ABCD patterns formed well in the established downtrend. 2 of the ABCDs formed nearly after the entire stock was cut in half. Now, this is an important point because a lot of times patterns will form and it will appear as if that the trend has already gone quite a distance, that perhaps the pattern signal itself is not going to yield much of a continuation. However, it's in these cases, in combination with the trend channel constraints, that we combine the pattern completion with the predominant trend to identify the continuation points and look for entries to go with the predominant trend itself. Complex patterns within trend channels. Complex patterns that form within well-established channels again signal a continuation of the primary trend. In this case, again, there are 2 types of patterns to consider within channels. Retracement channel patterns such as a Gartley, 5-0, or a BAT typically develop in areas of consolidation in conjunction with the constraints of the channel. Extension patterns such as a crab, a butterfly, or an alternate bat frequently possess more extreme price action, as these structures include some type of extension to validate the setup. Bullish retracement pattern in a bullish trend channel. Typically we'll see a well-established trend channel and then see some type of retracement, again with an ABCD component, but more of a defined retracement pattern that occurs at or just below the lower support constraint of the trend itself. On this example of the Chicago Mercantile Exchange, the CME formed a really nice bullish Gartley in a well-established bullish trend channel. Again, it might be difficult to perceive much of an opportunity, as we note the CME in the preceding year rallied from 250 to 450 and then formed a bullish Gartley. If we didn't know about harmonic patterns, we might look at this trend channel and say that the stock itself is nearly doubled. How could this be a bullish opportunity? This is where bullish patterns combined with a bullish established trend mark important and substantial continuation points. Looking at the price action in the potential reversal zone of the bullish channel, we clearly see the numbers and the pattern completion point fall just under the support channel of the trend. These situations are excellent because the pattern itself will pinpoint the price area for the execution. Meanwhile, the entire trend itself gives you that support, that is, the wind at your back, if you will, that we're following the main predominant trend, using the pattern itself to key in on where the continuation of this larger trend will occur. We look at this chart. After the pattern completed, it rallied over 100 points. That's quite a move. bullish extension pattern in a bullish trend channel. Typically, we're going to see a bullish crab, bullish alternate bat, or even a bullish butterfly, again completing typically below the trend channel constraint. Now, extension patterns will typically go below the trend line support more so than retracement patterns that fall within trend channels. So when we're looking at an extension pattern, such as a crab or a butterfly, we want to look for that completion point just below the trend channel. Many people who are looking at simple trends themselves, might look at the breakdown or price action that trades just below the trend channel as a potential violation or even a possible sell of technical failure of this trend channel. But when we have harmonic patterns that occur in these areas, they define excellent continuation points. Possibly the trend channel might be failing in terms of the price action nature itself. But knowing what we know about harmonic patterns and the signals that they yield, when we're looking at that lower channel support, these extension patterns are going to pinpoint the continuation areas. Looking at this chart on the 15-minute of Home Depot, we see a bullish crab inside of an established bullish trend channel. Again, the crab on the intraday chart tested all of the numbers in the potential reversal zone while testing the lower trend channel constraint. Looking at the price action in the potential reversal zone, clearly we see all of the numbers being tested that corresponded with the lower range of the support channel. This is where we combine the trend channel with the harmonic pattern to define excellent continuation areas. Bearish retracement pattern within a bearish trend channel. Looking at retracement patterns again, typically we're going to see a retracement pattern that occurs at or just beyond the downtrend constraint of that resistance. On this 5-minute chart of Alcoa, although it might be difficult to see this bearish Gartley in the established downtrend, this pattern pinpointed the continuation of the intraday downtrend. But let's look at the price action in the potential reversal zone. Clearly, the bearish Gartley marked a substantial potential reversal zone that, in combination with the bearish trend channel, defined excellent resistance and an excellent downtrend continuation. Bearish complex extension pattern within a bearish trend channel. Again, when we're looking at extension patterns and channels, these are more typically going to extend beyond the constraint of the channel. In this downtrend, we're going to look for harmonic patterns that complete just past the upper range of the downtrend resistance. Here on this 5-minute chart of Alcoa, we see a bearish crab inside of a bearish trend channel. Now, again, it's important to notice that the potential reversal zone completed just at the top of that downtrend resistance. In combination with the channel, this marked an excellent area for the continuation. Looking at the price action in the potential reversal zone, we see that the trend channel itself contained the entire intraday predominant trend. That is, the bearish trend channel put the predominant trade and predominant continuation of a downtrend move of the major force at hand. In combination with the pattern itself, the potential reversal zone defined the exact area for the continuation of this intraday downtrend move. Harmonic trading and technical indicators. Now, there are many indicators and oscillators developed within technical analysis in the past 100 years. Stochastics, MACD, ADX, RSI, are just but a few. But really, there's only a few measures that truly complement harmonic trading techniques. And actually, many of these technical indicators and oscillators are misunderstood and actually improperly applied in most cases. But for harmonic trading purposes, RSI, that is, relative strength, is the most effective. Relative Strength Index, RSI. The Relative Strength Index was developed by Wells Wilder in the 1970s and originally released in his book, New Concepts in Technical Trading Systems. Now, this was a remarkable technical work. Wells Wilder introduced several other indicator and oscillator studies, including the Directional Movement Index. Now, the Relative Strength Index was devised as a means of calculating the change in momentum of price movement as it relates to a predetermined time period. RSI, that is, the relative strength we're discussing, does not compare the relative strength of two securities, but rather the internal strength of the price action of an individual issue. RSI is a price-following oscillator that ranges between 0 and 100. That typically the RSI peaks above 70 in overbought situations and bottoms below 30 in oversold extremes. The signal usually forms these readings before the underlying price action reverses. This is an important concept because RSI is typically going to give us an early signal and is probably one of the most misunderstood concepts of the RSI. Many people will look at these extreme readings and think that just because we hit an extreme area, that automatically generates a trade signal. That's not true. We're going to look how to apply RSI to harmonic patterns. The RSI equation. Now, most, if not all, software programs will automatically calculate what the RSI reading will be. But for our purposes, we can quickly review this equation and the dynamics of RSI itself. Relative Strength Index equation is derived by calculating the ratio of the average number, or X number of price bars, their closes up, divided by the average number, or X number, of price bars closes down. Although X can be any value, Wilder in his book employed a 14-period factor in his computations. Now the equation is as follows, but really the 14-period average is what we use in harmonic trading, mostly because Wilder that's what he has proposed. And in my studies, although I have experimented with shorter time periods and longer time periods, his 14-period average works best. It's important to look at some relative strength considerations to better understand what these readings mean. Now, this equation quantifies the relative momentum of the current price action with that of, in our case, 14 periods ago. The extreme RSI readings provide excellent measures to the degree that the price action has persisted, and the continued strength or momentum of the predominant trend continues. The true value of these readings occurs when the price action and the indicator react at extreme areas. When the RSI tests an extreme overbought or oversold area, at critical harmonic levels of support or resistance, that is pattern completion points, the price action can reveal a great deal regarding the potential state of the predominant trend. There are two types of relative strength indicator structures that I have personally devised when it comes to harmonic trading. These two general classes of indicator structures that test the extreme levels of either overbought or oversold are classified as impulsive and complex. An RSI reading must test the extreme oversold area, that is 30 and below, or overbought area, 70 and above. Again, the RSI extreme reading is typically an early signal before the reversal occurs. It's important to simultaneously analyze RSI extreme tests with price action in the potential reversal zone. And then finally, the RSI trigger bar is a unique concept that I developed. This is the price bar that marks the reversal from the extreme area. That is, the singular price bar that takes the RSI reading out of its extreme zone. When compared with potential reversal zones, these can provide early indications of valid pattern structures and trade executions. Impulsive indicator structures. An impulsive indicator structure reflects price action that is experiencing a quick test of the extreme area that typically reverses quickly without any consolidating price action. And the RSI reading will typically rally above the extreme area in the overbought case, typically within 1 or 2 price bars of the initial test. It's important to focus on the nature of the indicator structure and not necessarily the exact numeric reading, as long as it's in the extreme area. The general indicator formation is the critical factor that serves as the essential trigger to validate a potential trade opportunity. Looking at this illustration of a bullish impulsive indicator structure, we typically will see price action that tests the entire potential reversal zone at the same time or slightly before the pattern is completed. Now, the price bar that takes the reading out of the zone is called the RSI trigger bar. Looking at this 15-minute chart of a deep bullish crab, we see that the pattern completed simultaneously with the oversold RSI impulse reading. Now, this is an excellent confirmation method because the RSI reading is telling you that the internal price action is changing. In this case, it's strengthening. In addition, in combination with the structural signal of the pattern, both of these complement each other extremely well. Reading the price action inside the potential reversal zone and monitoring the RSI reading gives us excellent means of validation of a profitable trade. Looking at the price action in the potential reversal zone, clearly we see how the price action stabilized at the pattern completion point simultaneously as the RSI reading reversed out of that oversold area. These are the minutiae details that give us the early indications of valid and profitable trades. Looking at a bearish impulsive indicator structure in the potential reversal zone, we want to take note of the reading, the RSI reading itself, as the pattern completes and the reading reverses out of the overbought area. Looking at this chart of gold on the continuous contract on a 5-minute, we see a bearish crab with a real nice impulsive indicator structure. Looking at the price action in the potential reversal zone, it's important to note how the price action tested the entire potential reversal zone. At the same time, the RSI reading tested the overbought area and then rolled out of the extreme zone immediately after testing it. Now, in combination with patterns, the RSI reading gives us that extra validation of a valid trade execution and profitable opportunity. The other type of indicator structure is the complex reading. Now, when we're looking at bullish complex indicator structures, these are going to be W-type structures in the oversold area. That is, the entire W-type formation occurs in the oversold area. This is different than impulsive readings because complex indicator structures require more time, more consolidation, but we want to simultaneously look at the price action at the pattern completion point with the relative strength reading. But it's important to know that the price action, again, is going to take a little more time than impulsive structures. Typically, a complex formation will trade in the oversold area for several bars before the pattern is completed. Looking at this chart of a Canadian dollar, we see a bullish butterfly on the 15-minute with a complex indicator structure. Looking at the price action in the potential reversal zone, we see this bullish butterfly was completed at the same time the RSI reading tested the oversold area. It's important to note that the complex formation, that is, that W-type structure, entirely formed in the oversold area. In combination with the potential reversal zone, this type of analysis gives us the early validation required to identify profitable trades. Bearish complex indicator structure in the potential reversal zone. Again, looking for this type of structure, it's going to require more time than just the simple impulsive reading. We want to look for, in this case, an M-type structure in the overbought area, that is 70 and above, at the same time the price action completes the pattern. This will take more time, but we're still coordinating the price action with the relative strength reading as it falls out of the overbought area. Looking at this chart of the Standard & Poor's 500 mini contract, 2011 from March, on a 60-minute basis, we see a bearish alternate bat structure with a bearish complex indicator structure. Looking at the price action in the potential reversal zone, again, it's important to note how the price action required quite a bit of time. The relative strength reading, that is, that M-type formation, required several price bars before it actually rolled out of the entire overbought extreme area. The key here, though, is to wait for the pattern completion point. Remember, relative strength is going to give you that early signal, but then when we link it up with a pattern completion point, that is, potential reversal zone, we get those early indications of a valid trade, that is, a profitable execution. We're still always looking to execute in the potential reversal zone, but understanding that the relative strength reading is rolling out of the extreme area in combination with the structural signal of the pattern itself gives us excellent validation of a profitable trade. Harmonic trading execution confirmation factors conclusion. Now, we've covered quite a bit of material here, and I would take time to go back and review this several times because there are many elements that are involved that you must simultaneously assess within a relatively short period of time. That is the potential reversal zone. We must consider confirmation signals simultaneously as a pattern completes. This is easier said than done. It takes a bit of study and practice, but you will guaranteed begin to see those early validation signals that separate the profitable trades from the losers. It's critical to assess the price bars in the potential reversal zone for those early signs of trend change. Remember, look at stuff like doji or hammer or other type of price formations simultaneously as the pattern completes. It's important, though, to assess the potential reversal zone as a defining structural signal for any setup. Also, look for patterns within the trend. No matter how far it seems to have persisted, that is, how far a price action has traded in one direction, when we have patterns that form within well-established trends, they give us great signals of continuation. Differentiate different types of RSI reading in relation to a pattern's potential reversal zone to assist in the determination of the price action. Now, this is an important concept. A lot of these relative strength strategies are proprietary that I have developed with harmonic trading, but they are effective early validation signals, again, that separates the losers from the winners. Finally, coordinate those confirmation signals that are the clearest and most reliable at the immediate completion of all pattern setups. Again, there's a lot of things to consider here, and I strongly recommend that you take time to fully assess all of these different factors at a pattern completion point, because when we're really trading and we're looking at multiple elements to determine whether or not to pull the trigger, we need to see several things line up simultaneously, because these situations and these factors are what clearly identify the profitable trade from the losers.